Wall Street is celebrating record highs. The headlines are cheering, CEOs are smiling, and stock indexes are breaking one record after another. But Main Street tells a different story. Everyday Americans are drowning in credit card debt. Car loan defaults are rising, rents are swallowing paychecks, and grocery bills feel heavier each week. It feels unfair. You hear the media praising a booming economy while you worry about making it to the end of the month without maxing out your credit card. And here's the truth. The cracks that shattered markets in 2000, 2008, and 2020 are flashing again in 2025. These aren't random blips. These are the same warning signs that appeared months before every major collapse. The question is not if a crash comes, it's when. And only those who recognize the signals early will protect their wealth and even turn crisis into opportunity. Stay with me until the end because I'll share a crash checklist for 2025, a simple but powerful guide you can keep and use before it's too late. Let's start with the bond market because it has whispered the truth before every major downturn. The yield curve, the relationship between short-term and long-term interest rates, is one of the most reliable recession indicators we have. In 2000, the yield curve inverted. When it uninverted, people thought the danger had passed. Months later, the dot-com bubble collapsed. In 2006, the curve inverted again, then flattened back. Analysts relaxed. Within a year, mortgage defaults surged, and by 2008, the financial system crumbled. Fast forward to 2025. Today, the curve has technically uninverted, but don't be fooled. Over 40% of maturities remain inverted, and the curve is frighteningly flat, like a rope pulled too tight. History shows the real danger isn't the inversion itself, it's the flattening afterward, when people breathe a sigh of relief. That's when the cracks deepen. And when liquidity dries up, markets don't drift lower, they collapse. But liquidity is only the first red flag. The bigger time bomb lies in corporate debt. For over a decade, companies borrowed heavily. Rates were near zero, money was cheap, and debt was easy. Executives refinanced, bought back shares, and boosted stock prices. Wall Street cheered, but cheap money is gone. Now, in 2025, those loans are coming due. Companies that borrowed at 2 or 3% must refinance at 6, 7, even 9%. Imagine owing money on a credit card at 2%, then suddenly facing 9%. That's the reality corporate America faces. In 2008, corporate bond spreads widened months before stocks collapsed. That was the canary in the coal mine. Today, spreads are near record lows. It looks safe, but it's a trap. Investors are desperate for yield, ignoring risk, just like in 2007. When those spreads finally widen, they'll snap wide open, and stocks will follow down hard. And much of this debt is tied to real estate, which is already cracking. In 2006, mortgage delinquencies quietly ticked up. Few paid attention. By 2007, foreclosures spiked. By 2008, housing dragged the entire economy into collapse. Today, commercial real estate vacancies are near 20% nationwide, the highest in decades. Office towers in New York, San Francisco, and Chicago stand half empty. At the same time, home affordability is at crisis levels. Young families can't buy, renters are stretched thin, and mortgage delinquencies are creeping higher again. These are the same early warning signs that appeared before 2008. If companies can't pay their debts and office buildings can't fill tenants, what happens to the banks holding those loans? You already know the answer. And yet, while these cracks widen, retail investors are acting as if nothing is wrong. In fact, they're celebrating. In 1999, small investors poured into dot-com stocks while insiders sold. Within months, the bubble burst. In 2021, meme stocks and crypto soared. TikTok traders bragged about overnight millions. And by 2022, much of it had collapsed. And now, in 2025, retail speculation is back with a vengeance. Options trading volume hit 1.2 billion contracts in a single month, the highest in history. Call option buying is off the charts, while corporate insiders quietly cash out. Retail euphoria is never a sign of strength. It's a warning. Sometimes the final trigger doesn't even come from inside markets. It comes from outside, from the shocks no one expects. In 1973, an oil shock sent the S&P 500 down nearly 40%. In 2020, A virus froze the global economy in weeks. Today, U.S. oil production is at record highs, but demand is flattening and inventories are building. All it takes is one geopolitical spark, conflict in the Middle East, tensions in Asia, or a sudden squeeze in energy, and fragile markets can snap. Put these signals together: liquidity stress, corporate debt, real estate weakness, retail euphoria, and geopolitical risks, and the picture is clear. And when you add valuations, it becomes undeniable. The CAPE ratio is at levels not seen since the peak of the dot-com bubble. The Buffett indicator is screaming extreme bubble. And while these metrics flash red, the gap between Wall Street and Main Street has never been wider. Wall Street celebrates record highs. Main Street struggles with rent, groceries, and debt. That disconnect, markets detached from reality, is exactly what happens before bubbles burst. Look back at history. In 2000, investors ignored yield curve warnings and extreme valuations. The crash erased trillions. In 2008, mortgage stress was dismissed until it collapsed the global economy. In 2020, bond market stress signaled trouble before COVID headlines hit. Every time the signals appeared first, the headlines came later. And today, in 2025, the same signals are flashing again. But that's why this channel exists, to give you the same tools, the same insights, the same early warnings, so you can protect what's yours.